Yeah, yeah. Wait. Yes. All of you quickly. Sit on the cameras. So actually, I was supposed to do dividends and ratio analysis. I had to complete, but I couldn't complete. So the classes got rescheduled. So I'm only left with one chapter now, leverages. So quickly we'll discuss that and we'll wrap up today's session. It'll be a short session. Okay.
Yes, sir.
Otherwise, we would have done leverages, dividends, and ratios. But since it's not completed, I'll be taking that up in the R2C session. Okay. The other chapters, leverages, I'll quickly complete. Yes. So, leverage is what? It is the influence or power of one financial variable over the other financial variable. Correct or not? Yes. All of you concentrate, sit straight now. Remember the seesaw example, right? So, how when you keep the lever, right, close to one financial variable, how a small movement on the one side will have a huge impact on the other side. Remember that example, one fat boy coming and sitting and the small boy goes flying up. No, that is nothing but leverage, right? So a small percentage change in sales may have a huge percentage impact on EPS. Clear, all of you? Yeah, don't make me spend my energy, guys. Please keep the videos on. I don't want to call each and everybody's name and tell them to keep it on quickly. Yeah, Sharanya, Tanya, Shreyas, Spurti, Rajashri. Yeah, everybody videos on, whoever is in the class. Yeah. So small percentage change in the I'm audible. Am I
Yes,
audible, everybody?
Yes, sir.
yes,
Yes,
sir.
sir.
Clear,
Yes,
loud
sir.
and clear. Yes.
Yes,
Yes,
sir.
sir.
Yes,
Yes.
sir.
So a small percentage change in sales may have a huge impact on EPS, right? Similarly, it's not just sales on EPS, it could be anything. Understood, all of you? That is leverage. So percentage change of one financial variable over the other, right? Yes. Okay, Spurti. So percentage change of one financial variable over the other, right? So here, for example, if X is changing, what is the impact it has on Y? If X is changing, what is the impact it has on Y? We call this as leverage of Y with X. Ulta ಅರ್ಥ ಆಗ್ತಿದೆಯಾ? Leverage of Y with X. Similarly, in my sales and EPS example, it is leverage of EPS with sales. Leverage of EPS with sales, that is percentage change of Y divided by percentage change on X. Percentage change on Y divided by percentage change on X. Therefore, combined leverage formula is percentage change in EPS divided by percentage change in sales. Is this clear? Right? Then leverage ಅಲ್ಲಿ there are two different risk, right? Two different risks. One is operating leverage and then operating risk and financial risk. Operating risk, we calculate it, we represent this by operating leverage. Financial risk is represented by financial leverage. Clear, all of you? Both of them put together is called combined leverage. Operating risk we will calculate from where? So you have to imagine your marginal costing and then here and then your FM. So until sales till EBIT, that is which part? That is my operating
Operating.
leverage. Clear, all of you? Sales till EBIT. EBIT to EPS is my financial leverage. Right? What is the risk here? Risk is my fixed cost. Right? In your operating leverage, ಅದರಲ್ಲಿ sales to DBIT, the risk portion is fixed cost always, correct or not? Because variable cost will be incurred only when there's a sale. Otherwise, it will not be incurred. So variable cost is not my risk. Until and unless obviously variable cost is more than selling price, which we are not discussing about. Assuming that variable cost is less than my selling price, in that case, the only risk is my fixed cost, whether I can meet my fixed cost or not. One above fixed cost, one below fixed cost is by operating leverage formula. What is one above fixed cost, one below fixed cost? Contribution divided by EBIT. Remember, all of you? Contribution by EBIT is my leverage formula. Next, operating leverage formula. Same way, EBIT to EPS. From EBIT to EPS, what is my risk? It is the interest cost, which is fixed in nature. Clear? Therefore, one above interest, one below interest. EBIT divided by EBT is my financial leverage formula. Clear? Then for combined leverage will be contribution divided by EBT. Contribution divided by EBT. Understood? So the one original formula we have already understood. That is percentage change in EBIT divided by percentage change in sales is operating leverage. Percentage change in EPS divided by percentage change in EBIT is financial leverage. Percentage change in EPS divided by percentage change in sales is my combined leverage. Is it clear, all of you? Next,
Yes,
we learned the relationship between your Marginal costing, margin of safety and your operating leverage. We understood that the relationship is inversely related. MOS percentage is inversely related to degree of operating leverage. Degree of operating leverage. So it is the reverse of it. Understood? So operating leverage formula is what? Contribution by EBIT. Here it is EBIT by contribution. Understood? So it is inverse related. What you remember is more than the derivation, it is the relationship that margin of safety and operating leverage are inversely related. Next, we learned whether operating leverage and financial leverage can it be between 0 and 1. We understood that it cannot be between 0 and 1. For it to be between 0 and 1, either one of the variables has to be so the denominator has to be more than the numerator. The formula is contribution by EBIT, right? The formula is contribution by EBIT. So denominator to be more. EBIT cannot be more than contribution. EBIT cannot be more than contribution, and therefore we cannot have the operating leverage or financial leverage for that matter between 0 and 1. It's either greater than 0 or less than 1. It's either greater than 0 or less than 1. Is it clear, all of you? Right? So these are my relationship. And then obviously you know the ROI, ROE relationship and all of that, which I don't want to get into from a leverage perspective. So from leverage, these are the concepts that you have to remember. Next is, which combination is the best? Low operating leverage, low financial leverage, then low combined leverage. We're not talking about that scenario. Both of them being high, that means it's high risk. It's not suggested. We want moderate risk. For it to be moderate, we are discussing whether operating leverage should be less and financial leverage should be more, or operating leverage should be higher and financial leverage should be less. When operating leverage is more, fixed cost is more. Fixed cost is more, EBIT will be lesser. Understood, all of you? And then what is the use of having lower financial leverage at that time? Because if financial leverage is there, in case where ROI is greater than I, always debt is preferred. Understood, all of you? Therefore, we understood or we learned that in case of finding the moderate risk, it's always best to have low operating leverage and high financial leverage. Clear, all of you? That means low fixed cost and high financial risk, such that it is balanced. Now you should balance the risk always, right? So in this case, you are balancing it, and as per FM, this is the best combination where operating leverage is less and financial leverage is highest, because you're trading on equity. What is trading on equity? When ROI is greater than I and you have debt. Most important, you should have. If ROI is greater than I but you don't have debt, then that's not trading on equity. ROI is greater than I and debt is preferred, and your company is financed by debt, then I would call it as trading on equity. It's also called double-edged sword, because you know the reasons, right? If there is a if the leverage is good, and if a small percentage increase in sales will have a huge impact on EPS, likewise it will also have a small percentage decrease in sales will also have a negative impact on EPS. Is it clear, all of you? Yes, so this is the sum and substance of your leverage chapter. Let us quickly go through the theory. Yeah. So represents influence or power of one financial variable over some other related financial variable. Yeah. Influence or power, underline that. These variables may be cost, output, sales, revenue, EBIT, EPS, etc. If you want to calculate the impact of change in X on Y, it is termed as leverage of Y with X. Underline that. That is percentage change in Y divided by percentage change in X. You can make a note there. On top, percentage change. The change in Y upon Y is percentage change in Y. Did you understand? Change in Y upon Y is nothing but percentage change in Y. Operating leverage is a relationship between sales and EBIT, also called business risk. Financial leverage is the relationship between EBIT and EPS, also called financial risk. Combined leverage relationship between sales and EPS, also called total risk. So until EBIT it is operating leverage, after EBIT to EPS it is financial leverage, and then total is my combined leverage. Formulas: percentage change in EBIT by percentage change in sales, degree of operating leverage change in EBIT by change in sales volume. So this is the derivation part. Okay, contribution by EBIT is what you have to remember. Break even point, that all that is not important from a revision perspective. What is important is your MOS percentage. MOS percentage is EBIT by contribution, right? Therefore we are inversely related. Can you please make a note of that? It's not mentioned here. Right here, MOS is inversely related. So that MOS in a relationship 1 by DOL. MOS this etara, right? MOS 1 by dual. Yeah, ಈ ತರ. MOS is inversely related to degree of operating leverage. Degree of operating leverage can never be between DOL and DFL. Please mention there DOL and DFL. And DFL. And DFL. Not just DOL, DFL also can never be between 0 and 1. Both of them together can never be between 0 and 1. Yeah. EBIT by EBT or percentage in EPS by percentage in EBIT. It is a double-edged sword. Right? Financial leverage as a double-edged sword. When cost of fixed cost fund is less than ROI, that is I is less than ROI is greater than I. Financial leverage will help to increase ROE and EPS. When cost of debt is more than ROI, it will affect ROE and EPS unfavorably. Right? Therefore, it is known as double-edged sword. Combined leverage is equals to contribution by EBT. Please mention here is equals to contribution by EBT. Is equal to contribution by EBT. Percentage change in EPS by percentage change in sales, and this also we discussed, which is the best. So the low anta bariri, it's not mentioned here. Please mention low here. Low DOL, high DFL is the best combination. Best combination. Trading on equity, I just now discussed, and then FL as a double-edged sword. All of you read these two also. FL indicates the use of funds with fixed cost like long-term debts and preference shares capital along with equity share capital, which is known as trading on equity. When the quantity of fixed cost fund is relatively high in comparison to equity capital, it is said that the firm is trading on equity. Right? The same thing is given here again. Here, all of you with the theory? All right. Now, let us go through some problems. Look at this, all of you. If the degree of financial leverage DFL is 5 by 4, which one of the following will be the interest coverage ratio? Okay, this interest coverage ratio in your ratio analysis will be learning. After that, you'll understand. Okay, how do we calculate? But interest coverage ratio is interest upon my how many times my earnings is being covered by interest. That is the formula for that. Okay, so DFL though, I think I'll do this once your ratio analysis chapter is done. Since the ratio analysis is not done, it is a combination question of ratio analysis and leverage. Look at this leverage problem. Following balance sheet and income statement have been obtained from the books of account. Okay. Now, determine the degree of operating leverage, financial and combined leverages at the current sales level if all the operating expenses other than depreciation are variable costs. Okay. That means variable cost is how much?
6 lakh.
6 lakhs. No. What is the formula for calculating your operating leverage? Contribution by EBIT, all of you? Yes or no? So 34 lakh sales minus 6 lakh of variable cost. Contribution is how much?
28 lakh. 28.
Right? 28 lakh divided by EBIT of 22 lakh.
20.
Contribution by EBIT. That is my operating leverage. Clear, all of you? Financial leverage is EBIT by EBT. Yes or no? Correct? EBIT by EBT, how much is that? 22 lakh by 16 lakh.
1.37.
So that is my financial leverage. Combined leverage, multiply the two, or it will be contribution by EBT. First one is simple. Next, if the total assets remain at the same level, but sales is increased by 20% and decreased by 20%, compute the earnings per share at the new sales level. So basically, relationship of sales and EPS, you use which leverage we will use? Relationship between sales and EPS, for this, which leverage we will use? Operating, financial, or
Combined
combined?
level.
Combined.
Leverage.
So whatever combined leverage you have found, use that to find out the percentage change in EPS. Understood, all of you?
Yes.
Right? So, and then current EPS you can use. What is the number of shares? 80 lakh by 10.
8 lakh.
8 lakh.
8 lakh.
Earnings before tax is 16 lakh. 16 lakh into tax rate of 35. So 16 lakh into 65% divided by 8 lakh. How much is the EPS? Ready?
1.3.
EPS is
1.3.
1.3. Okay, hopefully you have done the correct calculation. 1.3. Okay. Now, combined leverage is bantu. Contribution is how much? 34 lakh minus 6 lakh.
28 lakh.
28 lakh is my contribution divided by EBT of 16 lakh. What's the combined leverage?
1.75.
1.7.
Yeah, that into 20%. How much?
0.35.
0.35. So 35% change, right? So if it's a 20% increase, you'll have a 35% increase on EPS. Understood, all of you?
Yes.
So whatever the current 1.3, on that we'll do. So let us see the answer. Yeah, combined leverage, operating leverage is 1.27, financial leverage 1.375. This you did a mistake. You told me it is 1.75. You should get 1.75. See, I told you it is 28 lakh by 16 lakh. How much are you getting 28 by 16?
Sir, EPS we told 1.3.
EPS ಅಲ್ಲ ಇದು degree of combined leverage how much you got?
1.75.
ಬಂತಲ್ವಾ? Okay, ठीक है. Then increase by 20%. See, this you don't have to do actually. Okay, so I'll tell you. Uh, they have asked what is the question? What is the EPS, right? So current EPS is how much? How much we get?
1.3.
1.3, right? So 20% into 1.75, you got 35%. Am I right?
Yes,
Yes,
sir.
sir.
Yes, sir.
Yes, so increase the EPS 1.3 by 35%. How much are you getting? Are you getting 1.76?
Yes, sir.
And decrease it and check if you're getting 0.85.
Yes, sir.
So when you have your leverages, obviously you can directly compute rather than making the entire income statement again. Okay. This is the RTP question, your latest RTP, Jan 26. Yeah. So look at this question. Majestic Limited, a manufacturing company, is evaluating its financial performance and considering an expansion plan. The finance controller, can one of you read? Bhavna, can you read?
Yes, sir. Majestic Limited, a manufacturing company, is evaluating its financial performance and considering an expansion plan. The financial controller provides the following information for the financial year 2025. Equity share capital, retained earnings, 12% debentures, EBIT, interest expense, contribution margin ratio, tax rate, operating leverage, financial leverage, combined leverage, working capital, current ratio, fixed asset turnover ratio. The company is now considering an expansion project costing rupees 25 lakh. It anticipates the following changes post expansion in 2026. Sales are expected to increase by rupees 50 lakh. Variable costs will constitute 55% of sales. Additional fixed costs due to expansion are rupees 10 lakh. The company is evaluating two financial options for the expansion. Option 1. Raise rupees 25 lakh by issuing new equity shares at rupees 10 each. Option 2. Raise rupees 25 lakh by issuing new debt at 12% interest. From the following information, you are required to prepare the income statement and balance sheet of 2025 based on the data provided, compute the EPS under each financing option, compute the operating leverage, financial leverage, and combined leverage for both the financing options, recommend the best financing option based on the EPS and impact of leverage giving reasons.
So this is a combination of your leverage and capital structure chapter, if you can observe, where they're telling you to choose the best financial alternative. Remember all of you, capital structure, right? And along with that, combined with leverage concept they've asked. Okay. Now, it's evaluating financial performance and all of this provides the following for the financial year 2025. This is the data for 2025 which they have given. After that, they've given that, right? It is now considering an expansion project costing 25 lakh. Therefore, what is my marginal capital required? Marginal capital required is now 25 lakh. Clear all of you? Yes.
Yes, sir.
So, because of this 25 lakh, the sales will increase by 55 lakh. Variable cost will constitute 55%. Have they given the current variable cost percentage? They have actually not given as of now. Clear? Now, if operating leverage is given and EBIT is given, then yes, the current one also we can calculate. ಅರ್ಥ ಆಗ್ತಿದೆ ನಿಮಗೆ? Yes, operating leverage is given, EBIT is given. That means you can find out what? Fixed cost. You can operating leverage and EBIT is there, right? What is the formula? You will get the formula. So EBIT plus fixed cost is nothing but contribution, and then EBIT is there. So using that you can find out what the fixed cost is and what the contribution is. ಏನಾದ್ರು ಅರ್ಥ ಆಗ್ತಿದೆ ನಿಮಗೆ? Operating leverage formula
Margin
is what?
ratio.
Yeah. What is operating leverage formula? Or contribution margin is also given, right? So contribution margin is given. That means PVR also can be found out using this formula. Also, you can find out. Okay, so that means current level we can find out what it is, and then after the post expansion, this data is they have given. Now contribution margin ratio is 40%. Andre illi 55%. That means 45%. It is changed now. Clear all of you? Then additional fixed cost due to expansion are 10 lakh. Okay, so under both alternatives, so look at this contribution. They have used my method to calculate. Look at this degree of operating leverage into EBIT 2.5 into 20 lakh 50 lakh. They found out what the contribution is. Clear all of you? Then contribution margin ratio is found out used to find out my sales. ಅರ್ಥ ಆಗ್ತಾ ಇದೆಯಾ?
Yes.
Right? That is used to find out sales. That's what I told you start. When I saw itself, I told degree of operating leverage and EBIT means I can find out contribution. From contribution and contribution ratio, I found out what my sales is. Right? Next, you have to construct the entire balance sheet, right? Because I have told you to prepare income statement and balance sheet of 2025. That means for the previous year. ಅರ್ಥ ಆಗ್ತಾ ಇದೆಯಾ? Entire year I have to construct. So ಇಲ್ಲಿ some of your ratio analysis knowledge also will come into picture. They have given current ratio. Yes, current ratio is given. Current assets by current liabilities. Clear all of you? So current liabilities is X, right? So current ratio they have given is 2. That means current assets by current liability is equal to current ratio, that is 2 times current liabilities. Current liabilities, where have they given? Look at this. Working capital is current assets minus current liabilities. Clear all of you? Working capital is current asset minus current liability. So using that and then using the ratio current ratio 2, they have equated the two and they've done this equation. Did you all understand how this is arrived at, all of you?
Yes.
Yes.
Yes. Then calculation of fixed assets using the fixed asset turnover ratio. Fixed asset turnover ratio given is 3 here, right? I told you always fixed asset turnover divided by fixed assets. Clear? So turnover is 1 crore 25 lakhs divided by 3 will give you the fixed assets of 41 lakh 66,667. Right? So you know the sales, you know the variable cost percentage contribution. Fixed cost is a balancing figure because EBIT you know, right? Then less interest depending on the data that they've given, less interest, then EBT, then tax percentage, earnings after tax divided by number of shares. You've done the income statement, and then the balance sheet, fixed assets we know, current assets we know, equity capital, retained earnings, 12% debentures, and current liabilities. All of that information given. Based on that, the balance sheet is done for 2025. Is this clear? Next, calculation of EPS in each of the option under expansion plan. Post expansion plan, sales will increase by 50 lakh. Clear? This is simple. Variable cost is now become 55%. So 1 lakh, 1 crore 75 lakh to 55%. Other the contribution, then fixed cost has increased by 10 lakh. So it becomes 40 lakhs. EBIT is now 38 lakh 75,000. Clear? Right? Next, under equity option and debt option, EBIT, until EBIT will it be same for both alternatives? Agreed, not agreed? Whether it is equity or debt, will the EBIT be same for both?
Yes, sir.
Yes.
Yes.
So EBIT is same, and then interest under the old scheme, interest for debt option will be more. Here, number of shares will be more. Please remember my financial alternative problem. Always prepare working note for calculating number of shares and interest under each of the financial alternative. Remember, in capital structure for each of the financial alternative, we were always preparing number of shares and interest, right? So here also calculate that and then solve this. So this is a good problem. All of you, I would recommend you to solve this problem because it is covering a lot of your concepts, including your capital structure and leverages, and to some extent ratio also. It's a beautiful problem. Please solve this. Easy problem, not complicated, but it is covering 3 chapters: ratio analysis, leverages, and capital structure. Clear? Therefore, recommended that you solve this problem. It will help you.
ABC Engineering Limited, a mid-sized capital intensive manufacturing company, is evaluating the risk return profile of its operations. The company currently operates at 75% of its production capacity. The following information relates to its current operations. Income statement at 75% capacity. Particulars amount. Sales revenue, variable cost, fixed operating cost, EBIT, interest on debt 12% debentures, EBT, tax rate. Additional information. The company has equity share capital of 2 crore, shares of rupees 10 each fully paid up. The current debt equity ratio is 0.75 is to 1, and the company is considering increasing its production to 90% capacity. At 90%, sales and variable cost per unit will increase proportionately. Fixed operating cost will increase by rupees 10 lakh due to additional maintenance, supervisory staff and overheads. To finance the additional working capital and fixed overheads, the company is considering issuing additional rupees 50 lakh in 13% debentures. The management wants to analyze the impact of increased capacity on operating leverage, financial leverage, and combined leverage, and the change in EPS. You are required to at 75% capacity, current scenario, calculate EPS by filing the missing figures. Calculate degree of operating leverage, degree of financial leverage, and degree of combined leverage. At 90% capacity with revised financial plan, calculate new DOL, DFL, and DCL. Revised EPS. Advise as to whether the company proceed with the capacity expansion and debt issue.
So again 5 marks there, but it is a similar problem to last time. Okay, the previous one at 2 different capacity levels, but here capacity levels are given at 75%, 90%. ಅದರಲ್ಲಿ ಏನು ಹೇಳಿದ್ರು, ಸೇಲ್ಸ್ ಜಾಸ್ತಿ ಆಗಿದೆ. ಅರ್ಥ ಆಗ್ತಿದೆ ನಿಮಗೆ? The difference between previous problem, this problem, what they're saying, instead of giving you what the increase in sales is, they're giving you capacity 75%, 90% ಆಗಿದೆ ಅಂತ. ಅರ್ಥ ಆಯ್ತಾ? So obviously you have to prepare similarly here also. At 90%, again the income statement is drawn up. Clear, all of you? So at your 75% capacity, make the income statement and then calculate the leverages. At 90% capacity, again the income statement is drawn up and then leverages are calculated, and then you have to answer obviously always based on wealth maximization, keeping in mind. Clear? So at higher capacity utilization, the company is able to generate higher EBIT and EPS. However, it takes on slightly more financial risk by issuing 13% debentures, which you remember, no, for us financial risk to some extent is okay as long as ROI is greater than I. Clear? Right? All right.
RGT.
ಒಂದು ನಿಮಿಷ ನಾನು ಹೇಳ್ತೀನಿ, ಎಲ್ಲ ಪ್ರಾಬ್ಲಮ್ ಆಗಲ್ಲ, ನಾನು ಹೇಳ್ತೀನಿ. ಇದು ನಾನು ಬರ್ಕೊಂಬಿಡಿ. ನಾರ್ಮಲಿ ಸ್ಟಾರ್ಟಿಂಗ್ ಸ್ಟೆಪ್, ಸಮ್ವೇರ್ ಯು ರೈಟ್ ಡೌನ್, ನಾರ್ಮಲಿ ಸ್ಟಾರ್ಟಿಂಗ್ ಸ್ಟೆಪ್ ಇಸ್ ಫೈನಾನ್ಷಿಯಲ್ ಲೆವರೇಜ್, ದಟ್ ಈಸ್ EBIT by EBT. Financial leverage is equals to EBIT by EBT, which is equals to EBIT divided by EBIT minus interest. Financial leverage is equals to EBIT by EBT, which is equals to EBIT by EBIT minus interest. Where interest would be given, financial leverage would be given, compute EBIT. ಅರ್ಥ ಆಯ್ತಾ? Where interest would be given, financial leverage would be given, EBIT missing figure. Normally. Next. or operating leverage, contribution divided by EBIT, which is equals to EBIT by plus fixed cost by EBIT. EBIT plus fixed cost by EBIT. Read this problem.
Financial information for the year 2023-24 of two companies, N Limited and C Limited, are as under. Details: N Limited, C Limited. Equity share capital ₹100 each. Debt, fixed cost, combined leverage, financial leverage. You are required to calculate contribution for N Limited and C Limited, margin of safety in percentage for N Limited and C Limited, sales of C Limited.
Margin of safety percentage. How will you find out? Quickly tell me. Margin of safety percentage is what?
1 by operating.
1 by operating leverage. Simple. ಅರ್ಥ ಆಯ್ತಾ? 1 by operating leverage. Right. So operating leverage, how will you find out when combined and financial leverage is given?
Combined leverage
Combined
divided
leverage
by
is equal to
financial
operating
leverage.
leverage into
Combined by-
financial leverage.
Combined by financial leverage will give you operating leverage. Clear, all of you? Once operating leverage is found out, the 1 by operating leverage is nothing but MOS. Is it clear? So
Yes.
MOS is found out, then contribution they're asking you. Here, operating leverage you find out, and then fixed cost, I just tell you the formula. When you know operating leverage and fixed cost, what you can find out? EBIT, and obviously contribution you can find out. Clear, all of you? Yes. So contribution is found out, MOS percentage found out, then sales. Sales is nothing but, sales is very easy. Here, combined leverage, financial leverage, contribution, fixed cost ಕೊಟ್ಟಿದ್ದಾರಲ್ಲ, from that you can find out. Then you can do the working back, because once you know EBIT contribution, then easily you can work back and then find out what the sales is. Let us anyway look at the answer. I told you financial leverage, normally this is the starting point, EBIT by EBIT minus interest, because debt to the percentage ಕೊಟ್ಟಿದ್ದಾರೆ. ಅರ್ಥ ಆಯ್ತಾ? So look at this. They found out what the EBIT is. Can you all see this, all of you?
Yes, sir.
Yes.
Then using combined leverage, contribution by EBIT, they found out what contribution is and MOS percentage. We have done long cut method. You can directly do the method that I told. Understood?
Yes.
Operating leverage, directly you can do that method. Okay. Now this is one thing. Illi mark it as important. Or months ಬಂದಂಗೆ ಇದನ್ನು ಮಾಡಿದರೆ, you please make a note of this. Let us assume PV ratio is 40%. Please make a note of this. Now assume the PV ratio to be 40% and calculate the sales. Okay. They have assumed the PV ratio to be 40% and calculate the sales, because there is not enough data. Actually, working back ಮಾಡ್ಕೊಂಡು ಬರ್ತಾ ಇಲ್ಲ. I don't know on what basis, but they've just assumed it on their own. So mark that as important. If a question like this comes, you need to assume the PV ratio and compute the sales system. Yeah, all these are easy. The interest expense is there, financial leverage is there. From interest and financial leverage, what you can find out?
EBIT.
EBIT can be found out. EBIT, fixed cost, what you can find out?
Contribution.
Variable cost, you can know what you can find out?
Sales.
So already almost the entire income statement till EBIT, Okay. Then interest expense is EBT also, tax rate, the entire income statement of company X is done. Here operating leverage is known, then sales is known here. Operating leverage, sales, variable cost. See, variable cost is 65%. That means contribution will be
35%.
yes. So contribution, then operating leverage and contribution, if you know what you can find out?
EBIT.
EBIT and fixed cost. So here also you can go up till then interest expense is there. So you here also you can easily compute the income statement. Clear?
Yes.
Yes, sir.
Think that's it. This is that problem. Remember, I told you I given it as homework chart one. Two arrow marks. You have to calculate for different operating. Then financial leverage again two arrow marks under each chapter. Each arrow mark. Then Pidya, homework problem. Caps material. I think
Yes,
question
sir.
4 or something.
Yes, sir.
Same problem. This is same problem. Okay, the situation 1, situation 2. This is the same problem. Yeah, I think that's it. Yeah. Remaining you can go through. And obviously, the problem that I've done in the class is extremely important. All the problems done in the class you don't miss, and then you can. So, sir, how do I cover so many problems? Try to solve a different type of problems that you can, and then always mark the important adjustments. Clear, all of you? Try to cover as many problems as you can. But solve not because FM you cannot read it. It's not a you cannot read it like a storybook. You have to solve the problems. Okay. Yes, so that I think it's a small, like I always say, it's a small and sweet chapter. Leverages and dividend decisions. Always give priority to it and complete it off. Okay. All right. Anybody, any doubts? Sir? All right. Yes, Ramya.
So that PV ratio, we're assuming it to be 40%. If a question like that comes, like, should we also assume as 40 or anything?
ಏನ್ ಮಾಡೋದು? Yeah, anything. That is fine. Any assume some PV ratio and go ahead. That's all. Because that question was incomplete and I don't think a problem like that will come again. ಅದೇನ್ ಮಾಡ್ತಾರೆ once the question paper is set, then later on they would have gotten to know that there is a fault. So in that they told, and most likely they would have given grace marks also for that. But when suggested answer come, they need to give no. So there they have assumed 40% and gone ahead.
Yes, sir.
Okay. ಅದೇ question ಮತ್ತೆ in if it gets picked and you come, then you please mention that same way you do it.
Yes, sir.
Yes, Aditya.
Yes, sir. Yesterday my cousin came and he's working for a company which is new, and he told me that the owners are funding it from their own expenses, the company. I mean the capital. So should we assume that it's equity and not the debt?
But again, depends. The owners can also fund it through debt also, right? Normally, we call it as bootstrapped companies where the owners, the promoters themselves are funding the whole company and they've not taken any, outside source of capital. Normally,
So
we call
but
it as
we can assume it
and
as
why
equity.
you want to assume? Why you want to assume? You check the facts. There's
Okay.
no assumption. You need to check the facts. Have they given the is if it's a private limited company, a director can also give the company money in the form of loan.
Okay.
Okay. He can
Understood, sir.
also give it in the form of loan. He can give it in the form of equity capital. So there's no assumption. You'll have to check. But I don't think what's the context here. Okay. In my regular class, you can ask that question. Yes. Anything else relating to leverage? That's all.
Yeah.
Ramya. That's all? Everybody
Yes,
else.
sir.
Yeah? All right. Thank you, everybody. Bye, all of you.
Thank you,
Thank
sir.
you.